Imagine owning a property that pays you every single month, even while you sleep. That's the power of real estate investing. Some of the world's wealthiest people built their fortunes through property because real estate can generate cash flow, long-term appreciation, and financial security. But here's the problem. Most beginners think investing in real estate requires hundreds of thousands of dollars or years of experience. The truth is, it doesn't. In this video, I'll walk you through a complete beginner's roadmap to buying your first rental property, step by step. By the end of this video, you'll understand how real estate investing works, how to buy your first property, how to generate passive income, and the biggest mistakes beginners must avoid. Let's get started. Real estate has been one of the most reliable wealth-building tools for decades. There are three main ways investors make money with property. First is cash flow. Cash flow happens when the rent you collect from tenants is higher than your monthly expenses, like mortgage payments, taxes, and maintenance. For example, if your rental property generates $2,000 per month in rent and your expenses are $1,500, your monthly cash flow is $500 profit. The second way investors make money is property appreciation. Over time, property values tend to rise. A house purchased for $200,000 today might be worth $300,000 in 10 years. That increase builds wealth. The third benefit is leverage. In real estate, you can control a large asset with a relatively small down payment. For example, with a 20% down payment, you can buy a $300,000 property using only $60,000 of your own money. Meanwhile, the property grows in value on the full $300,000. This combination of cash flow, appreciation, and leverage is what makes real estate so powerful. Before buying your first property, it's important to understand the different types of real estate investments. The most common option for beginners is rental properties. This involves buying a property and renting it to tenants for monthly income. Rental properties can include single-family homes, apartments, condominiums, multifamily properties. Another option is short-term rentals. Platforms like Airbnb allow property owners to rent homes for short stays. In popular tourist areas, this strategy can generate significantly higher income than traditional rentals. However, short-term rentals also require more management. The third type is real estate flipping. This strategy involves buying undervalued properties, renovating them, and selling them for profit. While flipping can produce large profits, it also carries more risk and requires renovation experience. For beginners, the safest and most stable option is long-term rental properties. One of the biggest myths about real estate is that you need a lot of money to get started. In reality, there are several ways beginners can buy property. The most common option is a traditional mortgage loan. Many lenders require a 20% down payment for investment properties. However, some programs allow lower down payments. For example, some buyers start with 3 to 5% down payments if they live in the property first. Another strategy is called house hacking. This means buying a multi-unit property and living in one unit while renting out the others. The rent from tenants can cover most or even all of your mortgage payment. Many successful investors started their journey using this strategy. In real estate, location is everything. A great property in the wrong location can become a terrible investment. When evaluating cities or neighborhoods, investors analyze several key factors. First is population growth. Cities with growing populations often have increasing demand for housing. Second is job growth. Areas with strong job markets attract new residents and increase rental demand. Third is affordability. Investors look for markets where property prices allow strong rental income relative to purchase price. For example, if a property costs $200,000 and rents for $2,000 per month, the investment may produce strong returns. But if the same property costs $800,000 and rents for $2,000, it may not generate positive cash flow. Smart investors analyze the rent-to-price ratio before buying. Before purchasing any property, investors perform financial analysis. The most important metric is cash flow. To calculate cash flow, subtract all expenses from rental income. Expenses include mortgage payments, property taxes, insurance, maintenance, property management. Vacancy allowance. Another key metric is cap rate or capitalization rate. Cap rate measures the annual return on a property based on purchase price. For example, if a property generates $10,000 per year in profit and costs $200,000, the cap rate is 5%. Higher cap rates generally mean higher returns, but they may also come with higher risk. Once you find a good property, the next step is financing. Most investors use mortgage loans from banks or lenders. To qualify for a loan, lenders evaluate several factors: credit score, income, debt-to-income ratio, down payment. A higher credit score often results in lower interest rates. Even a small difference in interest rate can save thousands of dollars over time. Some investors also partner with others to raise capital for larger investments. After purchasing a property, the next step is managing tenants and maintenance. Some investors manage properties themselves to save money. Others hire property management companies to handle tenant screening, rent collection, and repairs. Property managers typically charge 8 to 12% of monthly rent. While this reduces profits slightly, it can save time and stress. Many beginner investors make costly mistakes. One common mistake is underestimating expenses. Maintenance, repairs, and vacancies can reduce profits if not planned for. Another mistake is buying property in a bad location. Even a beautiful home can struggle to attract tenants if the area has weak job growth. The third mistake is overpaying for a property. Successful investors focus on buying properties with strong financial fundamentals. Real estate investing can be one of the most powerful ways to build long-term wealth. With the right strategy, even beginners can start building passive income through rental properties. Remember the key steps. Choose the right market, analyze the numbers carefully, secure smart financing, and manage your property effectively. Over time, your properties can generate consistent income and long-term financial freedom. If you enjoyed this video, don't forget to like, subscribe, and explore more content about real estate investing and luxury property tours on this channel. Your journey toward financial freedom through real estate starts today.